Hi, Kuma.
Hello, Fiona. How are you?
Hi. Yeah, I'm okay, thank you. Sorry about that. I was having trouble with the internet.
Stormy weather.
Yeah, it's really, really windy here at the
Oh,
moment.
yeah. It's February.
Yeah,
Yes, I know. Yeah.
yeah. So it's obviously affected the internet connection. So
All
hopefully
right.
it seems okay now. I
Yeah.
haven't managed to print off the question yet
Okay.
because I hadn't been able to download my emails, but
Okay.
hopefully I'll have to pull that off shortly. But I can see you. Yeah.
Okay. But I could not go to your answer on the question what you did. Most likely tonight I will go to that one.
Oh, okay.
Yeah.
Yeah, I know I've made a few errors on it, and
Okay.
I wanted to do it under the exam conditions
Right.
because
Yeah.
obviously on the day that is how it's going to be.
That's
So
correct.
I know,
Yes.
I know that I've made some mistakes, but I thought, well,
it's all right. Let's. I'll go through that one and we will discuss it maybe tomorrow. I think we have a class. We will discuss it then.
yes, okay.
Right.
Yeah,
I want
that's
to.
fine. Okay.
I picked up a question, a big question on the cash flow, 50 marks.
Okay.
So this is also examination question, but this is one of the models they have given. So far they have not tested us, but this is one of the model questions they are given. So shall we go to this one?
Yeah. Okay.
Right. So let's we'll try to understand the question here, and then we will try to work through. So once a little bit of a nasty one again. Normally we see financial statements ending 31st March or 31st December or something, but here he has taken the liberty of putting 31st January.
Okay.
So that means the financial is from February to January, because it took me a little bit of time, because there was a acquisition that happened somewhere in 2015. I was wondering how come 2015 can come, because I was thinking of 2016 December, but later on I realized, oh no, their financial is from February to January. So the current financial is from February 2015 to January 2016. So they are given us the following relates to the financial statement of Western Group. So the moment you say Western Group, you must understand it's the consolidated statement, even though it is not told. Right?
Yeah. Okay.
Normally they should have told Western Group's statement of consolidated financial position, but they have not said. If we had done that, they will cut some marks from us, but for them they can do it. They say financial statements of the Western Group, but ideally they should have said consolidated, but they are not mentioned. But we need to know it's consolidated. So property plant we can see, goodwill we can see, other intangible assets we can see, investment in associate we can see. So surely in addition to the subsidiaries, they have a couple of associate companies, or maybe one, because they say investment in associate, current assets, inventory, trade, financial assets at amortized cost. Now that's a very important one. This is under current assets, so that means it is valued at fair value to profit or loss. It's a short-term investment, so that needs to be very carefully taken up. Then share capital, no changes. Retained earnings, yes, there are changes. Other components of equity, there are changes. Uncontrolling interest, there are changes. On-term borrowing, because when you are doing the cash flow, what we need to look at is all the changes. Net deferred tax liability, then current tax payable, all that is there. Then we have been told Western Group, again without saying consolidated, they say Western Group, statement of profit or loss, comprehensive income for the end 31st January 2016. Now this is where I got little bit confused. The moment I saw 31st, I thought it is December 2016, and I was thinking January to December period. But suddenly I realized, no, it is 31st December, January 2016 means our financial is from February 2015 to January 2016.
Yeah.
So we are given admin expenses, share of profit of associate, profit before tax, all that. A little bit of an asked one. They have the IFRS 5 brought in, profit for the year from continuing operations, and they have loss from the year of discontinued operations, and then ultimately the profit. To that, we have other comprehensive income. Surely the remeasurement gains comes under other comprehensive income. Total comprehensive income is 120.
Yeah.
118, they have distributed between the parent 170, 107, say 11, 121, again 110 and 11. Let's look at the notes. Yeah.
Yeah, I was going to say, and that's quite confusing that they've given both. It's a lot of information to take in, isn't it? Because,
lots of information, a heavy one.
Yeah.
It has the discontinuing operations, continued operations, then it has the comprehensive income, associates, I mean almost everything. So in a way I was happy that I came across this question, because if we can do one or two of these questions, I think we should be all right to handle the cash flow. Yeah.
It covers a lot of areas, doesn't it? It's so much.
Yeah.
It's so much to do in that time though, because again, the 35 marks.
I know, yeah. It's not only that, once you go to the notes, you will see it even has deferred tax and so many other things like.
Yeah.
So let's look at the notes. Yeah, it's a heavy one. Actually, honestly, no one can do it in these examination situations. There are no way you can do this kind of a question. The only way I can think of is they are not thinking of people getting 100% marks. They are thinking of people getting 50% marks.
Just scraping through.
Yeah, exactly. Yeah, because I don't think even the brilliant student can do all the things in that exam mentality. Think about it. It took a lot of time for me to figure out the question and to see what approach I can take. So that's what I'm going to discuss with you today. On 31st, 2015, so this is where I got confused. My mind was on, when I said 2016, I was thinking of December 2016, but suddenly I realized 31st July 15, because always in a consolidated cash flow, what we know is we will definitely have acquisition of a subsidiary during the year or a disposal of a subsidiary during the year. Last time when we did it was a disposal. This time it was all about an acquisition.
Yeah.
So on 31st, Western disposed their entire 80% equity holding in Northern for cash. So that means we don't have anything. Everything is disposed. That has happened. Remember the period is February to, so February, March, April, May, June, July. 6 months to the year, they have disposed the whole thing. Right? 6 months to the year, they have disposed the whole thing. So in the consolidated P&L, surely 6 months figures are consolidated, and after that it's not there. But the balance sheet, we have to remember, none of these assets will appear, because on the balance sheet date of 31st January 2016, subsidiary is completely sold.
Yeah.
This subsidiary. But there will be other subsidiaries. Right? There will be many other subsidiaries. This particular subsidiary, the Northern, is completely disposed. Shares had been acquired for a consideration of 132 million when the fair value was 124. This included a fair value uplift of 16 million. So you can see another confusion, another complex thing. The fair value includes a 16 million in relation to plant with a life period of 8 years. Deferred tax, again, deferred tax also they have put it on that one. On the fair value was correctly provided in the group accounts and is included in the fair value of net assets. The fair value of the non-controlling interest at the acquisition was 28 million. Goodwill calculated on the full fair value method was tested annually. At 31st January 2015, goodwill relating to Northern had been impaired by 75%. So you have to remember this impairment has happened before this financial year. It is
Yes, it's in the
in the
yeah.
last financial year. So there is nothing to the P&L in this financial year of that impairment. So goodwill impairment charge has been included within the administration expenses for the current year, but does not relate to Northern. So in a way, she's little bit generous. She says there is a further impairment, but that the Northern impairment is not included because it has happened in the previous. Carrying value in the individual accounts or Northern at the disposal are listed and inventory, receivables, paid and other payables, deferred tax, bank overdrafts. So let it be there for the moment. Loss for the period from discontinued operation, they have a profit of 6, but the income tax they have to pay 2 million. Loss on disposal is 29, so that's how the breakdown of 25 million is coming up. Purchase 40% on 1st February 2015, that is at the beginning of this year. Associate paid a dividend in the end at 31st January. Retirement liability, that I think the SEC examinee is very, very focused on this IAS 19 retirement liability. All the time, whatever the question, we have a retirement liability little bit. Net obligation,
yeah. And that bit totally threw me. We'll talk about that tomorrow once you've had a look at my answer.
Okay.
Well, actually, sure. I didn't really, I couldn't do that bit because it wasn't it was a benefit, a defined benefit.
Right. Okay. Okay.
Yeah. So that is an area that we need to look at because it confused me.
Okay, so we will look at that one. Surely we'll look at that one. Yeah. Because I saw much more than the CIMA examiner. ACC examiner is focusing on the IAS 19.
Yeah, and that seemed to be the bit that was missing, the obligation. There was a remeasurement, that was fine. Okay. I took that to the OCI and
okay.
But there was a but yeah, once you have a look at it, we'll talk about that. But this one,
because I think in most of the ACC questions I have seen is what I've seen is they've given always the net obligation or net assets. That means the plan obligations minus plan assets.
Yeah, there was a liability on the other question. And that
here also net obligation means it's a liability. So assets minus liability opening balance is 72. The moment they say net obligation. CIMA mostly they give the assets and the liabilities separately. We have to work it through. But here they go on the net obligation most of the time. Let's look at that question because I did not even read that question. So net obligation 72, service cost component 11, contribution to scheme 19 million, remeasurement actuarial gains 4, net obligation 60. So what you will realize this here, the 11 million is a non-cash item. It's charged to the P&L, but it's a non-cash item, right? What they do is they will debit the P&L, credit the obligation account with 11 million. So when you are preparing the cash flow, it's charged to the P&L, but it's a non-cash item. The real cash item is the 19 million, what they have paid out. When you are preparing the cash flow, we are looking only for the cash items. So that 11 need to be added to the profit and 19 need to be deducted when you are working out the operating activity. 4 will come up under this thing, what is called 4 will come under other comprehensive income. Benefit plan is for the period by the trustees for 7 million. Benefits paid in the period by the trustee. Now that is not our cash flow. That is not the company cash flow. It is paid out of the fund. So that will not come into our main company cash flow. For the main company cash flow, it is the 19 million which the company has invested in the pension fund.
Yeah.
Right? Western operates in a country which only allows tax relief when contributions are paid into the scheme. The base was therefore 0 at 31st January 1315 and 31st January 16. So the country in which they operate, they don't allow contributions when we debit the P&L or when whatever, they give it only when we pay, right? So the tax rate is defined benefit expenses is included within the administrative expense. Commence development expenditure on product Q. Q is expected to be launched during 2017. 7 million amortization is included within the cost of sales. So that's a non-cash item which we need to add it back to our profit. No disposals property plant during the year except the sale of the Northern. Depreciation for the year was 20 million included within the cost of sales. So that is some generosity, I would say. We don't need to calculate the amortization. We don't need to calculate the depreciation. Already two figures are there in the note number 5 and 6. 7. Financial asset is amortized at 20 million. Cost is a 20 million 2-year loan which Western gave it to an unconnected company on 1st February 2015. So 1st February 2015 is at the beginning of this financial year. 12-month expected credit loss was estimated 1 million, have been charged to the admin expenses. Coupon and effective rate is 8%. Interest was received on 31st January, recorded correctly in the consolidated statement, despite a significant deterioration in economic conditions. As a result, the investment is to be downgraded with an expected 40% chance of a default. No entry has yet been made to downgrade the investment in the consolidated financial statement. Included within the trade and other payables at 31st was contingent consideration of 10 million. Discount rate of, so this is at the beginning of this year, there was a contingent consideration of 10 million. Discount rate was used to measure the fair value of this obligation. This arose on the acquisition of Eastern, a subsidiary acquired several years ago. Consideration to be paid was contingent, but the company did not perform well, and therefore Western paid only 7 million in full settlement of 31st January. So obviously there is a little bit of a gain which they would have recorded in the P&L, which we need to remove because it's not an uncashed item. It's an uncashed item. West did not pay a dividend to shareholder during the year 31st December. So prepare the group cash flow indirect method for the year ended. Now, the first thing I was thinking, the moment this question came to me, I was thinking, what should my approach be? There are a couple of approaches I can apply. I can look at the balance sheet, the way, the movement from last year to this year. I can take that approach and do it. Otherwise, I can take the P&L and look at the operating activities, because you remember cash flow comprises 3 components: the net cash investment from operating activities, investing activities, and financing activities. Right? So what I did was you can do either way. What I did was, since I read the whole question, I took the approach to first to do the operating activity. Because I knew I will not be able to do the entire question in the time given. So I want to get the maximum points. So what I realized was I will do the operating activities because that's where the maximum points come. I thought I will do that one. So what I did was I just prepared a little bit of a pro forma Western Group consolidated statement of cash flows for the year ended 31st January 2016. And I have read the question. Now I said that I started with my first compartment, cash flows from operating activities. You remember our first item is profit before tax.
Tax, yeah.
Right. Then we add many items: depreciation, amortization, any impairment, right? Any impairment, then pension scheme contributions or the pension scheme book entry, service cost.
Yeah, and for the cash flow, you need to remember the formats.
Format you must remember. Formats you must remember. I mean, you know, there will be few here and there new things coming up, but the overall format you can remember. Always you start with cash flows from operating activities. Starting one is profit before tax. Then add depreciation, generally they are there because we saw depreciation is there, amortization is there, impairment is there. Then we saw another one is that what we call the service cost. Then there are certain deductions what we do. You remember we deduct the finance cost, or rather we add the finance cost. At the finance cost, the finance cost is also non-cash item. We want to see how much we really paid. At the finance cost, deduct associate company income, because that is not a cash item. Cash item will be the dividend received. Deduct associate company income, share of profit.
Yeah.
Then any, so those are few things that you probably will know immediately. Keep about 2 or 3 blank lines. Then we can say operating cash before changes in working capital. I'm just keeping 2 or 3 lines. There may be a few other things which I'm coming up, but I will enter those things later on.
Yeah. So the profit before tax is 183.
Now that one we have to be careful. Although it is 183, it is not so. Because when a discontinuing operation comes up, you remember in that P&L, there are two components. One is from the continuing operations. We have got a profit of 183. You are right. But we have to look at the discontinued operation under note 2 and include that one also. So remember that one. So 183 plus 6 should get included. But that's not all. In this P&L, they say, as you go down, they say something. Now, this is what I was trying to explain to you. I will note down. Here they say, if you look at the number 7 note, no entry has yet been made to downgrade the investment in the consolidated financial statement. So my profit need to get adjusted for that adjustment. So what I do is whenever I get a note like that, I will underline that one and I will say P&L adjustment. You understand, right? So we have to adjust our P&L. Our P&L, although it is prepared, is not properly right because this adjustment has not been done. So whenever in the notes examiners say no adjustments have been done in the P&L, or where they say it is incorrectly done, we must correct those things, Fiona.
Yeah, okay.
Before we can do anything else. So what I did was, I did a little bit of working for you because I thought this is a bit of a heavy one. So I just did a little bit of working which I will share with you. Just before you came into the class, I was doing this one, at least to a great extent. So what I did was, I did some workings. Profit before tax for the year, continuing operations 183, discontinuing operations 6, total 189. Then I said adjustment. Adjusted profit is 182. How did I get that one? What I did was I looked at the financial instrument note number 7 where they say there was a issue. So if you remember that note number 7, what are they saying? They say note number 7, financial asset is amortized, cost is a 20 million, 2-year loan which gave an unconnected company on 1st February 2015, that is at the beginning of the year. 12-month loss was estimated at 1 million. It is already charged to the P&L and have been charged to administrative expenses, right? So that is why you can see the financial asset is appearing at 19 million. 20 was the original figure, but they have written off 1 million to the P&L and it is appearing at 19 million. That is what is going in the balance sheet. And now we have to look at the entry that we have to downgrade the investment. How much more we have to charge it. Now, it was given for 2 years. So, one more year to go. So, it will be 31st January 2017. 31st January 2017, how much we have to receive altogether? 20 million is the nominal value. 8% is the interest. So, we should get 20 million plus 8%, 21.6. Right?
Yep.
Right. So 21.6 we have to get it in after 1 year. That is on 31st December 27. The present value of what you are going to get in 1 year later, 21.6, if you discount it backwards, take in the 1.08 because it is 1 year, so you don't need to go by the tables. You can just divide it by 1.08. If it is 1 year, it's 1.08. If it is 2 years, 1.08 into power 2. So 1.08 if you take, the present value is 20 million. All what we have to get is 21.6 in 1 year later. The present value of all that is 20 million. Is it clear?
Yes.
Right. What is estimated to receive is only 60% of that present value, which is going to be 12 million. Right? Which is going to be 12 million. What is it appearing in the balance sheet at the moment? 19 million. Right? It is appearing in the balance sheet at the moment at 19 million. So, we have to do a further impairment of 7 million. Further impairment of 7 million. So, our profit, what was stated earlier, what are the profit we stated? 183 from continuing operations. From discontinued operations 7, we need to readjust that profit by 7 million. That is what we call the additional impairment. Additional impairment. So, your adjusted profit will be 189 minus 7, 182. That is your starting point.
So, how was 7 calculated? Because I'm getting 8.
Pardon?
So, 21.6 was the start.
Counted to 1.08, it is 20 million.
Yeah.
Right? 60% receivable is 12 million. Okay. Already they have charged 1 million, no? In the P&L, and that is why in the balance sheet you have only 19 million. But the 19 million figure should be reduced to 12 million. So what we have to charge as additional impairment is 7 million. Understand?
Yes, yeah.
Total impairment is 8 million, which we have to add back later on. That's all right. But what we have to charge to the P&L or P&L should be properly corrected by adding another 7 million or deducting another 7 million from your profit. Is it clear?
Yeah.
Right. That is what I did. So there is a 7 million. Now once I bring it to 182, the adjusted profit, that means there is a 7 million impairment plus another 1 million impairment. Both that is non-cash flow, which we will have to add it back. When you are preparing the cash flow, we will add back. But the profit we need to take as 182.
Yes.
So I will now, because that's the only adjustment to the profit, because normally the profit is always correct. This is the first time or very rare occasion I saw the profit, we have to go and adjust it. We can always take the P&L figure and go on. But remember, if it is discontinued operation, that profit also must be taken. So I took both the figures, 183 plus 106, 189, and I had to do this adjustment and I came to 182. So my profit from profit for the year, profit before tax is 182.
Yeah.
Depreciation, you can go and straight away add the 20. You can in that cash flow pro forma, you can add the 20 straight away. Amortization of intangible assets, according to note, amortization of intangible assets, there was a figure. Amortization of intangible assets. Can you see the figure? I think it's somewhere below. Amortization of intangible assets. I think it is somewhere in the note number 5.
Oh, yes.
Note number 5, that also you can add it because that is already charged to the P&L. So 182 is your profit. Depreciation you will add 20 million. Amortization of intangible assets, that's a non-cash item. That also you will add it. And also you can straight away add the impairment on this financial asset. This financial asset impairment, 7 million plus 1 million, 8 million. 1 million already charged to the P&L. We now charge another 7 million. So 7 million plus 1 million, 8 million you can charge it to the P&L.
Yeah, okay.
Right. Then service cost component. Service cost component according to the note number, that is that thing. Service cost component was 11 million. That is not a cash item. That also you can add it. Right? That also you can add it. Then finance cost 23 million. There were no issues there. That also we can add it. Because that's a non-cash item, or rather what we take is what we have paid. So we can add the 23 million. Then the service cost that we have to pay, cash contribution to pension scheme, 19 million, it's outflow. We must remove it, deduct. Cash contribution to pension scheme, because the service cost we added, but the real cash outflow is 19 million, that you will deduct. Associate profit, you will deduct it because it's not a cash item. So it's included in the profit of 182. So you must remove that one minus 16 million. Minus 16 million.
And so was that was just picked up? They've already given us that, have they? Oh, yes. Okay.
Okay.
Yeah.
Right.
Yeah, because it's always yeah.
Yeah, because it is in the P&L, share of associate profit. So remove that one because we don't take that one. We take the real dividends received under investing activity. So remove that.
Yeah.
One, 16 million. Now, there are two more things because the examiner said there is some more impairment in the goodwill. So we have to calculate the goodwill impairment. Right? Because the examiner said somewhere, he says, she said something like this, included, yes, there's something. He said a goodwill impairment charge has been included within administration for the current year but does not relate to the northern. So now we have to find out that how much is that impairment. To do that one, we need to do a little bit of workings, right? So we have to calculate that thing. To do that one, we must know of the asset what we disposed or the subsidiary what we disposed, what is the goodwill that we disposed. Because at the beginning of this year, in that balance sheet, when they said the goodwill is, 19 million, it included this subsidiary's goodwill loss, correct?
Yes.
So we have to now calculate the goodwill of this subsidiary what we dispose on the day of the disposal. So to calculate on the day of the disposal, we have to calculate it first of all on the day of acquisition. because we know 75% was impaired long time ago. So can we calculate the goodwill on the acquisition of this subsidiary? We calculate the goodwill of the subsidiary on the acquisition. Let's look at note number 1. Acquired the subsidiary, the fair value of the net assets was 124. Consideration they paid was 132, and there was NCI 28 million. So can you calculate the goodwill on the date of acquisition of this subsidiary? Always keep the workings attached to the examiner, because even if you make arithmetical mistakes, still if the method is right, you will get some marks.
Yeah, okay. $36 million.
Goodwill at the acquisition is 132 was the consideration. NCI was 28, 160 minus 124, 36 million. Exactly right. Now 75% of that is impaired very early. Goodwill impairment, right? It happened on 31st January 2015. Before this beginning of this year, financial year, it has happened, and 75% is impaired.
Yeah, so that's 27 million impairment.
Impairment. So what is appearing in the opening balance sheet is only 9 million. Relating to this northern subsidiary, the goodwill that is appearing is 9 million, correct? 36 is the total goodwill. 27 already impaired. So what was there in relation to this subsidiary, what we disposed, was only 9 million.
Yeah. Should be 9 million, yes.
Now when we dispose that subsidiary, the 9 million should go off. So we start with the opening 19. When we dispose subsidiary, that 9 months go off. Correct? With the disposal. Yes. So 19 minus 9 is 10. Now we have a goodwill of 4. That means there is a further impairment of 6. Right?
Yeah.
So that impairment is already charged in the P&L. That also must be added back. So 19 minus 9 minus 4 should be added back to the cash flow. So that's another 6 million.
Yeah.
Another 6 million added back. Now only one more adjustments as far as I remember. It is the number 8. Right. This is a kind of a thing. What has happened? So we want to see what is the gain on that thing. Would I charge it to the P&L? Would I taken the credit into the P&L? So we have to reverse that one because that's not a cash item. Included within the trade and other payables was a contingent consideration of 10 million. That is, at the beginning of this year, there was a figure of 10 million. A discount rate of 10% was used to measure the fair value of this obligation. This arose on the acquisition of Eastern, a subsidiary acquired several years ago. The consideration to be paid was contingent on the profits. Eastern did not perform well as expected during the year, and West paid 7 million in full settlement of the obligation on 31st January 2016. So at the beginning of the year, figure is 10 million.
Yeah.
10 million. Now, a discounting rate of 10% is used means every year, with the discounting rate of 10%, we will increase that liability by another 1 million. Charging it to the P&L 1 million. We would have credited the P&L at the beginning of the year. At the closing year, with the charge in P&L 1 million as interest, and we will credit the liability by 1 million. So the closing liability what would have appeared in the balance sheet would have been how much? 10 plus 1, 11 million.
Yeah.
How much is final settlement? 7 million. So what is the gain we have got? What is reflected in our P&L?
4 million.
4 million. That must be removed. That must be deducted because it is part of your profit, but it's not a cash item, because the cash item is what we paid. So we have to remove that 4 million. So remove that 4 million. So that is what we call the gains on contingent consideration. 10 plus 1, 11, minus 7, 4, removing. So with all these things, now you should be able to arrive at operating cash flow or cash flow from operating activities before working capital changes. Can you see whether you can get that figure? Cash flows from operating activities before working capital changes.
195?
195, yes. You missed 1 point. Finance cost.
Finance cost, yes.
Should have been added up, 23.
And where did that come from?
Because that is in the P&L. Finance cost, because you remember in the we take the finance cost after all these things. The finance costs and tax we take as what is really paid. We add what is charged in the P&L, and in the bottom we remove it as a amount paid. Always the finance cost what is charged in the P&L we add back. We take later on as from operating activities, we take the what is really finance cost paid and the income tax paid.
So that's 218.
218. So that is what we call cash flows from operating activity before working capital changes. Now we go to the working capital changes.
Okay.
So let's look at the, first of all, the working capital changes. Current assets. Current assets changes. We're going to look at. Current assets, trade inventories. We start with 165. Right? We start with 165. Of course, we dispose the subsidiary, and we have disposed that part of the inventory. Which was
38.
38. So minus 38, 165 minus 38, 127. What is your closing figure? 108. So the balance in figure 127 to 108.
That's what's been paid.
Yeah.
Is 19.
19. So our inventory has come down by 19. So that means it's a inflow, decrease in inventory. So that means it's a addition to our cash flow of 19. Can you similarly do the trade receivables?
Yes.
Can you do the trade receivables?
Yeah. Okay, so opening balance is 104.
And then 4.
Then disposal of the subsidiary is 23.
Yeah.
That's 81. Then the
Closing is,
so it's 25 million.
yes. Inflow, outflow.
Yeah, that is a it's an increase in receivables.
Yeah, increase in receivables means it's an outflow, isn't it?
Yes. Yeah, so it's deducted.
Yeah, increase in receivables is outflow. Now can you look
Yeah.
at the trade payables? But trade payables you have to be very, very careful with one little thing, because they say something about the trade payables. Now this is where I will go and I know in my trade payables I have to do a little adjustment. Let's say trade payables, there was an adjustment what we need to do, and therefore we need to be concerned. So I will, in my question paper, I will put just TP or something like, because I know when I'm doing the trade payables, trade receivables, no adjustments necessary, inventory, no adjustment necessary, but trade payables, I know I have to do a little bit of an adjustment. So how do I do that one? So we have opening balance of 41.
Yeah, then we've got the disposal subsidiary, which is 10.
Yeah, disposal
So
of subsidiary, was it 10?
Yes.
Disposal
So
of subsidiary.
31. Yeah.
Disposal of subsidiary is 10, correct?
Then we've got the...
Then we must look at the note number 8. Carefully think what we need to do. Note number 8. Look at what we need to do, that one. Now there was a liability at the beginning of the balance sheet, 10 million, isn't it?
Yeah, there's a 10 million contingent consideration, and that was only 7 million paid in full.
Yeah, so now, yes, okay. Now in the closing balance sheet, there is no balance, isn't it?
No, there isn't, no.
Yeah, so that 10 million, we have to remove it from our opening because it is completely settled. So we will take the settlement later on, but we have to remove that 10 million also from our opening balance. Because we paid only 7 million, so we can't just take that 10 million, that kind of a thing. So we must remove the entire 10 million.
Yeah.
So 41 minus 10 minus 10.
Yeah, comes down to 21.
21, and now we have 15, I think. Or rather, no, 36.
Where?
36, no?
36, yeah.
So payables have increased by 21 to 36 by 15 million. 15 million, isn't it?
Yeah.
So that's the inflow. That's the inflow.
Right, I'm going to add those onto the
218 figure, just add all those and then we will get the what we call cash generated from operating activity. Cash generated from operating activities.
Yeah.
How much is that figure?
So inventories.
Inventories was plus 19.
So that's 19, that's added.
Trade receivables minus 25. Trade and other payables 15.
Yeah, and that's an increase, so that is added on. Dean. Okay, so that then brings us to
yeah.
Oh. 227.
227, and that's what we call cash generated from operating activities. So to arrive at operating activities cash flow, we need two more items. One is the income tax paid, other one is the finance cost paid. Now if you look at that balance sheet, there is nothing called finance interest payable opening or closing, right? So because of that, whatever we have charged to the P&L, 23 million, subject to any non-cash adjustment is what we have paid. Because normally we have a balance sheet figure opening thing that in this balance sheet you don't have that one. So that means opening and closing is zero. So already what we have charged to the P&L is what we have paid, subject to any non-cash adjustment. So there was one non-cash adjustment. The P&L charge is 23 million, but we know 1 million was that discounting rate for that contingent liability. So 23 minus 1, 22 is the real cash paid. So finance cost paid will be 22. Finance cost paid will be 22. 23 minus 1.
Okay.
That is all right. Now we have a little bit of a complication on the taxes. Taxes, as you know, always what we take is you take the opening deferred tax and opening current tax payable. So opening deferred tax plus opening current tax payable, 15 plus 92, 107. Opening deferred tax is 15. Opening current tax is 92. 15 plus 92, 107.
Yeah.
Then we must see what we have charged to the P&L. Now here also you have to be careful. There are two charged to the P&L, one under continuing operations, the other one under discontinuing operations. So under continuing we have charged 40, and under discontinuing under note number 2, we have charged 2 million.
Yeah.
So our opening liability 107 will go up by 40 plus 2, 42. Then we have a little adjustment to think about on the disposal, what we had to pay as taxes. So they say something in the note, they said something about the disposal. Yeah, the disposal, in the disposal already there's a deferred tax liability of 6 million. Correct?
Oh yes, yeah.
So you have to remove that 6 million. You have to remove that 6 million. But also you have to remove another one, because in the fair value adjustment, you remember there was a 16 million fair value adjustment. Right? The uplift was 16 million. Deferred tax at the rate of 25% of the fair value was currently provided in the group accounts and included within the fair value of net assets. So on the 16 million, 25% is 4 million.
Yeah.
Right? And this 4 million, it is having a life period of deferred tax. The note number 1 says was adjustment in the correctly. And it says something, fair value adjustments correctly provided, included in the fair value 31st is with a remaining useful life of 8 years, right? So on 31st July, the fair value was uplifted by 16 million with a life period of 8 years. Now, when we dispose it on this day, what was the day that we disposed? We disposed it on 31st July 2015, 4 years later, we disposed it. So out of that 4 million, 2 million would have been charged to the P&L. Because whenever deferred tax is there every year, you will take the proportion of deferred tax also into the P&L. So out of the 4 million, 2 million would have been already charged to the P&L. So there is another 2 million which is there in our consolidated or in our 2 million should be in the another 2 million liability should be included. So whenever we dispose the subsidiary, we are disposing what is appearing in their books of 6 million plus another 2 million which we have in our consolidated accounts.
Yeah.
So the total deferred tax that what we are going to get rid of is 6 million already in the subsidiary books plus the 2 million unwritten off deferred tax 2 million, 8 million we have to remove. So that's why I put a 8 million minus. Open in 107, P&L charge 40, discontinuing 2, disposal of the subsidiary, it's not only 6 million, that other fair value adjustment, because normally in SIMA questions I have seen they say ignore that deferred tax on fair value adjustment. But ACC examiner has said even that should be included, and she has already said 25% of the fair value is always adjusted as deferred tax. So on the 16 million, there would have been a 4 million deferred tax liability set at the outset. 2 million would have been already credited to the P&L. Half of the life period is gone. The balance 2 million, it's in our consolidated opening balance of that 92 million. And that 2 million also will have to go off. Right?
Yeah.
Then we have another little thing on that. What is our net obligation? They say that tax base of the first 0 at 31st, the tax rate by, so 31st December 0 and 31st January 0, but we know remeasurement actuarial gain is 4 million. On that 25% need to be provided. Whatever in the OCI, that 4 million, 25% we need to be provided. So we need to add another 1 million liability to deferred tax in respect of that 25%. 4 million, 25%. So when you add all that, I got a figure 107, opening plus 40 plus 2 minus 8 plus 1, I got a figure of 142.
Yeah.
Closing figure is 14 plus 47, deferred tax plus current liability. So the balancing figure is 81 million.
Yeah.
That 81 million is a cash outflow, that is what we have paid. So that also now you can take it. Finance cost paid is 22 million. Income tax paid is 81 million. And now it will give us the net cash generated by operating activities.
And that's 146.
Net cash generated by, no, 227 was the earlier figure, no? Minus 22 minus 81.
Where did the 22 come from?
The finance cost. Finance cost. That is 23 was the P&L charge, but we know 1 million is a non-cash item. So 23 minus 122.
Yeah.
So you should have a figure of how much?
I wrote
124.
Yeah. So I wrote that on the wrong line. That's why I missed that.
All right.
So it's yeah. It's you end up with a really scrappy looking.
Yeah, I know. Yeah. So anyway, now we have come to we have gone to the difficult part. The others, I don't think there are any errors. So what you can do is you can put a try on the investing activity and the financing activity.
Yeah.
See whether you can get it. Tomorrow when we meet, we will discuss this one and the other question also.
Okay. Yeah. So that came to 124.
Yeah.
Now at the moment.
124, no?
Yeah.
124.
Okay.
124 is the net cash generated by operating activities.
Yeah.
See whether you can do the investing. See whether you can do the financing, and see whether you can come closer. But we will look at this part and the other part and the second part of this question also in our tomorrow session.
Okay.
Right. So I'll see you tomorrow at the same time.
All right then. Thank you, Skuma.
Okay, take care. Bye, Fiona.
Bye.
Bye.